the final ratios or indicators we are going to tackle is the return one. So there we are going to look at two: the return on the owner's equity and the percentage earnings by the partner. Now, if we think return, we are thinking the bottom line. Bottom line, we are thinking about profit. So that which the owners invested in the business, did it deliver a recent return? Or would they have been better to safely invest their money in, for example, a fixed asset? That's what it's all about. So first, let's look on the return on owner's equity as a whole. This is basically exactly what it says, because return, as we said, is the net profit. So the bottom line, we find the bottom line of the income statement, which is net profit, and we divide it by the average owner's equity, where average owner's equity is the owner's equity at the beginning of the year plus the owner's equity at the end of the year. Add them up, divide by 12 to get, by 2 rather, to get the average, because average is simply half of the beginning owner's equity plus the ending owner's equity. And then we multiply by 100 to get the percentage. And this percentage we will compare against alternative investments like a fixed deposit. Okay, so there are a few factors to consider. How long did the business operate? Usually, or very often, a business as it starts actually operates at losses, but once it survives, it tends to start to make profits. Also, obviously, the current economic climate may play a role. Is the economy in a recession or is it in a growth phase? Also, did the owners increase their capital or maybe decrease their capital? That might have an effect. Okay, so now where the return of owner's equity focus on the partnership as a whole, we also want to compare the various partners and see what each one of them, what their particular earnings is, to see for each partner if it is worth the while for that particular partner. So what we do is we are looking at the total earnings of the partners divided by the partner's average owner's equity, multiplied by 100 over 1 to get the percentage. Now the total earnings by the partner is what the partner is entitled to according to the partnership agreement. So it will be your stuff like your salary plus your interest on capital plus bonuses if there are any, and then the remaining profit share or loss share. And we already said we divide by the partner's own average owner's equity, and the partner's owner's equity consists out of the balances of the capital and current accounts. Since we are dealing with the average concept, we will take the capital and current accounts at the beginning of the year, add it to the capital and current account balances at the end of the year, get the total, take half of it, because we are dealing with an average. When a current account has a debit balance, in other words, the partnership, the partner rather owes the partnership, then we subtract that. Obviously also if the profit is negative, we will have to subtract. So the figure here will usually be higher than the return on owner's equity because the partner's salary can be quite a significant amount. Usually we will have to therefore more compare to previous year's figures rather than alternative investments.